and good afternoon. Welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is, of course, dealing with the hot issue of the time. It's our corporate income tax series webcast, and it's entitled the G20 and the OECD Pillar 1 and Pillar 2 project. What are the latest developments and what can we expect? My name is David Watkins and I'm a tax partner in Sydney, Australia, and I will be the host of today's webcast. I'm very pleased to be joined by two of my colleagues, Amelia Teng, who's a tax partner in Melbourne with a particular focus on Pillar 2, and also pleased to be joined by Bob Stack, a colleague based in Washington, DC, and previously a key member of the Obama administration and their engagement with the very first rounds of BEPS back in 2013, 14, 15. And here we are some 5, 6, 7 years on, still working on the BEPS process. A little bit of housekeeping for today. First, all participants, all users are on listen-only mode. If you have any content-related questions, please submit them in the Q&A box at the bottom right of your screen. We'll aim to respond to some of those questions during the course of the presentation today, and if not, we will respond after the session. Second, all PC users can maximise or minimise each box on the console, and if you want to download today's slides or any related publications, you can go to the Downloads and Link box. Mobile device users can view the slides on the screen. Finally, if you require an attendance record for this event, there is an ability to download a CPE certificate, clicking the icon which says Request CPE, which is at the bottom of the webcast console. So with that introduction, let's move on to the content for today. And the agenda is, as you can see, what are the latest developments? And frankly, a lot happened on this process in June and July of this year. Having looked at what's just recently happened, we'll then break the presentation up into Pillar 1 and Pillar 2. And each of those pillars can get super complex. We're aiming not for this to be a hyper complex session, trying to stay above that level to give people a better sense of direction and what are the key concepts and what are the still missing concepts. And then we'll move on to next steps. What happens over the course of this year? What happens over the course of next year with a view to these significant measures being introduced in 2023. Just probably one other point I'd make by way of introduction, and at the risk of drawing on the Olympics for a metaphor. If you've ever been to the Olympics or indeed to an athletics event, they're fascinating days because there's multiple events going on across the arena. You'll have the high jump, the shot put, the running races. I think that's quite a sort of apt metaphor for what's going on here, because this process is happening at multiple levels. There's multiple events going on at the same time. There's the political dimension to this, and that's already played out multilaterally and will continue to play out multilaterally, but then that will roll into the domestic country political agenda in the next year or two. There's also the technical event being played out here. Again, that initially starts with the OECD still developing the detail, but then that has to cascade into local country implementation. And then finally, there's the corporate perspective. What does this mean for my company, for the company that I work in? And each of these different pillars and the different parts of the different pillars typically apply to different types of companies. So there will be some companies in the world who are, affected by all of these elements. There'll be other companies, other smaller businesses who are affected by some but not all of the parts of the different pillars. So I think it's kind of important to think about where your company sits in this perspective. But as I say, there's really three different processes playing out: the political process, the technical process, and then ultimately what does that all mean for your particular organisation. So if we move on then to the latest developments, and if we go to the next slide, please. As I say, a lot happened in June and July. If you roll back to the end of last year, this process was struggling under its own weight. We had the blueprints, which were heavy on complexity without a lot of simplicity. We had COVID, which had delayed the process in 2020, but it also necessitated the need for greater revenue. We had sort of uncertainties about how the US administration was engaging with the process. We had a proliferation of digital services taxes. And so by the end of the last year, this process was really heavily challenged. But a lot of significant developments have happened literally in the last month or two, and they're depicted on this slide. Firstly, in early June, we had a G7 political agreement, and that was high-level political commitment to the broad architecture of both Pillar 1 and Pillar 2. Next, as the dominoes kind of fell, we had the inclusive framework, the 139 countries meeting virtually to put their stamp on this process. And so what we saw at the end of June and the start of July was a overwhelming majority of the inclusive framework, 130, now 132 countries of those 139 countries supporting the consensus position. And that OECD inclusive framework position is summarised in a statement that was issued on the 1st of July. It's a 4 or 5 page document, very high level, but again, identifying those key measures for which we now have 130 countries, 132 countries committed to. That's an extraordinary achievement for a process that, as I say, late last year was perhaps losing momentum. And then following the inclusive framework process at the end of June, we had the G20, so a broader group of key countries around the world also agreeing to that high-level framework. So that, frankly, is a significant, extraordinary achievement in a very short period of time. So what has been agreed, and so let's just outline that at a high level. Pillar 1. Pillar 1 is really pretty significant. It's all of the norms that we've had around international tax for the last 100 years, a lot of those are being broken down by Pillar 1. Pillar 1, and principally the Amount A aspect of Pillar 1, moves away from a single entity principle. It moves away from an arm's length principle and moves towards a formulary apportionment for part of the profit of a large multinational group. It moves away from taxation being linked to physical presence, from traditional concepts of permanent establishment to a non-physical presence. So it really is a fundamental reform. So next level down, Pillar 1, Amount A, as depicted on the screen, it's an allocation of a slice of the profits of the largest and most profitable businesses around the world, perhaps as few as 100 of those companies or thereabouts. It's an allocation of a slice of their profit to what we now call the market country, the country in which the goods or services are purchased or consumed in broad terms. And when I say a slice of the profit, the OECD, all of these statements that have been made describe the slice in the same way. It's 20 to 30% of the profit in excess of a 10% profit margin. We'll dig into that a little bit more. Part of Pillar 1 Amount A is also the commitment to remove digital services taxes. Pillar 1 also includes Amount B. We'll touch on that briefly as we progress. In terms of Pillar 2, this is the introduction of a global minimum tax of at least 15%. That's equally significant as a really dramatic change in the global tax architecture. So in the space of, well, depending on how you look at it, over a long period of perhaps 3 or 4 years, this process has been meandering along. But in very quick order, over the course of June or July, some really significant agreements have been achieved, which sets up the next step. So what we also want to do at this initial level, and I'll bring Bob in a moment, what I've kind of tried to describe there is what's happened in the last month or so, what are the key elements of the high-level agreement that has been reached. But perhaps if we kind of look behind the scenes a little bit, Bob, how did this process get this momentum in June or July? What have been the key shifts?
Yeah, thanks, David. I think, the most interesting thing I think that happened is U.S. domestic politics drove a lot of, first, the U.S. kind of engagement at the OECD, and I'll unpack that, and then it drove a lot of the consensus. And let me just explain that. The Biden administration, when they came into office, first of all, they won some key Senate races in Georgia, which all of a sudden gave the Democrats, the same party as President Biden, control of our Senate, our House, and the White House. It's not usual that we have that. We have a very different political system than the parliamentary system around the world. So all of a sudden, the Democrats had an ability to actually enact things. And the Biden administration was very, very focused on building infrastructure in the United States, getting all sorts of things going that they had to raise revenue for. They wanted to raise our corporate rate all the way up to 28%, still do, and our own minimum tax rate, called the GILTI, up to, let's say, 21%. Well, they knew immediately that if they tried to do a minimum tax rate of 21%, that companies were going to go up to Congress and say, well, this is crazy. We're the only country in the world with a minimum tax, and we're going to put our companies at a competitive disadvantage, and it would make it hard to get this through Congress. So the first thing and the most important priority for the administration was, well, we better get the rest of the world to also enact the minimum tax. And that kind of lit the fire under the administration to kind of get in there and go out to the rest of the world and say, hey, you folks should have a minimum tax too. It's a way to address the remaining BEPS concerns. And that's what, as David mentioned, we've got this agreement now that there will be some sort of a minimum tax of at least 15%, which permits the Biden administration to continue working with Congress to also increase our minimum tax rate. Now, as you may know, there were many countries that weren't particularly interested in Pillar 2 and the min tax. They really wanted Pillar 1 that David described, because they viewed that as the vehicle to tax, the giant U.S. tech companies. And so the U.S. at the same time had to kind of come to the table, and I'll talk about it, with approach to Pillar 1 that would also be satisfactory to the rest of the world. And they did that. And that jump-started the talks, as David said, took it out of the doldrums from last year and really accelerated them forward based on these U.S. proposals that turned out to be acceptable. The Biden stuff will get enacted in 2021 or not. So there's a disconnect in the timelines of when the U.S. has to do its tax reform that intersects, interestingly, with the fact that the Pillar 1 and 2 timelines are a little off that, and that just creates another interesting political dynamic in the United States. Specifically, will the U.S. jump first to raise its min tax rate before we really know exactly what the rest of the world is going to do on Pillar 2? David, I'll turn it back to you.
Yeah, so, I mean, I think that is again, there's a good metaphor in there that this whole process is so connected. Pillar 1 is connected to Pillar 2. Parts, the global program is connected to local country implementation. And in a sense, as you've just described, we can sort of draw a line all the way from those runoff Senate races in the state of Georgia back in November or December of last year. We can kind of draw a line from there all the way through to where we are now. So let's now start to get into that next level of detail, understanding the high-level framework of Pillar 1, Pillar 2, and Bob, if you can pick that up with Pillar 1.
I sure can. I think David already covered the Amount A, right? It's this kind of reallocation of taxing rights of the largest and most profitable businesses into these market jurisdictions. It's the most radical element, I think, of Pillar 1. And I'll give you a little more detail on how that works. Amount B, David mentioned, is basically to solve the problem of what should distributors earn all around the world. That would apply to all businesses. And we'll fill you in a little bit on Amount B. It's been put on a slower track for now. But the third piece of Pillar 1 is a lot of businesses and governments got engaged in this whole Pillar 1 because they thought we could perhaps have more tax certainty in the system, so companies didn't have to spend so much time and effort all around all the different kinds of disputes that they have all around the world around the very issues that are here. And so the tax certainty is a big part of this agenda. If we go to the next slide, you may recall that in the blueprints that came out in in the blueprints that came out last October, the proposal was to apply Pillar 1 Amount A to two different types of businesses: automated digital services and consumer-facing businesses. Now, we got there because the rest of the world really wanted to limit Pillar 1 Amount A to digital services, because this whole project began as a taxation of the digital economy project. But the U.S. came along and said, well, wait a second. If we're going to change the rules of international tax, which everybody says haven't been changed in 100 years, the U.S., through three administrations, our administration, the Obama administration, Chip Harder, my successor in the Trump administration, and now the Biden administration, have said, we're willing to revisit the rules. We're just not willing to revisit them for a particular sector in which the U.S. is so strong. And so it was the U.S. that brought to the table this concept of let's think about markets don't get enough revenue, either from automated digitals or consumer-facing businesses. So those were the two pieces of the work as it went forward. Well, from the U.S. perspective, when they made new proposals to the OECD in April, remember I mentioned they really wanted to get Pillar 2 going, but they also wanted to jumpstart Pillar 1. And they kind of said, first of all, there's going to be a lot of disputes around what really is a consumer-facing business. If you studied the blueprints, there was a lot of discussion around if a pharma company sells over-the-counter drugs, is that consumer-facing? But if it's a prescription drug, is that not consumer-facing because it runs through the doctor? And so there was a lot of concern on the part of the U.S. that all this line drawing was really going to be quite difficult to do in practice and difficult to administer. So the U.S. then took the view that, we really are only after the companies that have these outsized profits and those companies with global turnover above 20 billion euros. The U.S. said, look, why don't we not do something like the country-by-country threshold of 750 million euros, which could have swept in hundreds of companies? Let's narrow this down to the biggest companies. And at 20 billion, we think there might be 100 companies in the mix. And oh, by the way, that's where really all the income is that would benefit the world if it was shared. So that was a huge step because it narrowed greatly the scope of Pillar 1. And then they said, let's have profitability over 10%, because the theory of all this is that companies that make a lot of money must have some intangible value. And that intangible value, economists call it rents, are not really getting shared equitably around the world. So we're going to do profitability over 10%. Now, because there were countries that wanted to do something lower than 20 billion, they agreed to reduce that threshold to maybe 10 billion euros, maybe in 2031. That was a political way to say, look, we're not ready to go there now, but we'll revisit that and maybe reduce it. And all of us should ask ourselves, is there a slippery slope element to this so that whatever is agreed now could over time erode and be applied more broadly to companies? And finally, they talked about, they carved out industries like extractives and regulated financial services for reasons that are somewhat unique to those types of industries. Financial services, maybe are regulated and are in the markets anyway through bank branches and the like. And extractives are viewed as basically coming out of developing countries, and therefore it would have been wrong to take some of the profit away from them and shift it into markets. So the recent work has kind of kept those carve-outs. If we go to the next slide, just the next question is, you'd say to yourself, well, how do I know I owe anything into a market? I mean, I sell all over the world, and you'd say, well, okay, so if you're in a country with a GDP of over 40 billion euros, most of the developed world, you're going to have to pay this amount into the market once your revenue from that market is over €1 million. But if it's a smaller country, we'll reduce that down to 250,000 euros. If we go to the next slide, I just want to take a moment on the tax certainty piece I mentioned earlier, which is basically what they said was, well, if you're a big company and we're throwing you into amount A, we really owe you some certainty. We have to come up with ways that when you do all the math and you determine who is the paying country and who gets the money, that you have a way so that the tax authorities will not bother you with audits all around the world on those numbers. And so they've want to come up with dispute prevention and resolution methods that companies can use to get certainty in this amount A. And also, they want to make sure that you can get certainty not just for that amount A, but imagine if countries said, well, we know your amount A is, $1 million, but now we're going to challenge you on your transfer pricing, or we're going to challenge you that you have a PE in my jurisdiction. So I think at the U.S. insistence, this certainty is going to get a little broader around every issue that a big company might have in this cross-border space. Now, and then for everything else, I should say, you're basically left with the normal things like MAP and other dispute resolution provisions. And then there's a separate out so that smaller countries that don't really have many MAP cases may get to do this mandatory amount A stuff on an elective basis, or so they can choose in or out, basically to take care of the fact that they don't have all sorts of resources and the like. David, you were going to give a moment on amount B, I think, and I'll turn it over to you to just highlight that.
Yeah, thanks. Thanks, Bob. So maybe if I just sort of do a quick little summary as to how I think about amount A, the world's largest and most profitable companies, a relatively small pool of companies. Some of those will be listening to this webcast. Many companies on this webcast won't be in that, let's say, top 100 of the world's largest and most profitable companies. But I think the importance, nonetheless, of Pillar 1 and Amount A is that all of these different proposals have got political and perhaps to a lesser extent technical interconnections. So even if Pillar 1 Amount A is not likely to be relevant to your organisation, it will still have an impact in the country in which you're based, in that, the country in which, your tax responsibility applies to will likely be collecting Amount A tax from those largest and most profitable companies. So when you think about how all these rules will play out as they roll into implementation in your country, then one of the aspects of that is that countries right around the world will be trying to do multiple pieces of domestic legislation at the same time, including to collect Amount A tax. So, as I say, if we assume that that's a relatively small group of companies that are affected by Amount A, if we then roll on to Amount B, though, Amount B is really applies to all companies. So on the next slide, if you just click forward to, Amount B, just as a reminder, was again in this vein of tax certainty, trying to say, how do we simplify, how do we give certainty to tax authorities and to taxpayers around the transfer pricing to be applied to their in-country marketing and distribution activities? Should their return be X% or Y%? Should it be a percentage of costs, a percentage of revenue? A lot of energy, a lot of dispute can arise around that space. How can this process, with a keen eye on arm's length principles, but how can we move beyond the uncertainty of arm's length principles and give certainty, as I say, both to administrators and to taxpayers for baseline marketing and distribution activities. Now, that's I think, a very sensible objective, but of course, like all of Pillar 1 and Pillar 2, when you get into the detail, the challenges start to emerge. What do we mean by baseline marketing and distribution activities? And what is the return to be allocated to those baseline marketing and distribution activities? Is it a fixed return, or is there going to be a range? And the upshot of that is that Pillar B has really been parked. It's been pushed out to run on a slower timeline than other parts of this process. So the statements that we have at the moment is that more technical work will be done in respect of Pillar B over the course of 2022, with a view to a final position being established at the back end of next year. So Pillar 1, Amount B, is on a slower timeline. So if we move on from Pillar 1 to Pillar 2 and the global minimum tax. So let me ask Amelia now to lead us through this. Thanks.
And David, before we do that, I just want to add something. Even if your company isn't really going to be subject to Pillar 1, Amount A, this whole thing could fall apart, because some countries, as I mentioned, that were not so crazy about Pillar 2 said, we'll do Pillar 2 as long as everybody goes along with Pillar 1. So we all have an interest in kind of watching both of them, even if only, for example, Pillar 2 that Amelia is about to talk about is the one that will hit your company. Over to you, Amelia.
Thanks, Bob. Thanks, David. Absolutely. The interconnectedness of both pillars is vitally important. So you're all familiar with the headlines. Pillar 2 is a global minimum tax, which is designed around a number of component pieces. And in contrast to Pillar 1, the changes since the blueprint have actually been quite minimal, other than, of course, the very important confirmation by the inclusive framework that the minimum rate must be at least 15%. So to recap on the key elements of Pillar 2, consists of a subject to tax rule, which is designed as a treaty-based rule. And this could apply in priority to a set of two interlocking domestic rules called the Income Inclusion Rule and the Under-Tax Payments Rule. The subject to tax rule is essentially a withholding type tax mechanism to ensure that a minimum tax is going to be paid at the source country level, and it will be limited to certain types of intra-group payments. Given it is a treaty-based rule, there isn't much clarity as yet as to whether or not it will have a de minimis threshold, so there's still some work to be done around that on the subject to tax rule. The Income Inclusion Rule and the Under-Tax Payment Rule, however, will apply to multinational groups that have revenues above the €750 million threshold, which of course aligns to the country-by-country reporting standard. The Income Inclusion Rule is the main rule, and it will apply at the top company level. And the Under-Tax Payments Rule is a backstop or a mirror rule that will only be triggered if the parent company does not implement an IIR. Now, one thing to note is that the Pillar 2 proposals do actually have the status of a common approach, which means that the inclusive framework members will not necessarily be required to adopt the rules, but if they choose to do so, they'll need to be implemented in a consistent manner according to the model rules proposed by the OECD. But of course, based on what Bob's just said, the political connection between Pillar 1 and 2 is so important, and the likelihood of having one without the other is something to note. If we just go on to the next slide, please. So with the revenue threshold, you can see Pillar 2 has the potential to apply to a much, much wider population than Pillar 1, and it will be relevant to a number of businesses headquartered across Asia. The definition of a multinational group that will be used will be based on the same definitions used in the country-by-country reporting rules, with a few excluded entities. So, for example, investment funds, pension funds, governmental entities, international organisations, and not-for-profits. All of these will be excluded from being the ultimate parent entity on the grounds that these entities are meant to be tax neutral or exempt from a policy perspective. However, the exclusion will not apply to the subgroups or the SPVs in which they invest. So the relevant question may be whether those individual subgroups meet the €750 million threshold. The inclusive framework also confirmed that international shipping income would be excluded from the rule, and that will be using or based on the definition in Article 8 of the OECD Model Tax Convention. Again, the logic being that this type of income is already separately dealt with through different policy lenses and through different levers. If we flick forward one or two slides now, we'll just briefly touch on a little bit more detail of the subject to tax rule. Just one more. Yep, thank you. So the inclusive framework has set the minimum rate for the subject to tax rule at between 7.5% and 9%. So we know there will be somewhere within that range. And that rate is set a little lower than the minimum rate for the income inclusion rule because it applies on a gross payments basis rather than on net profits basis. If those two were to align, of course, the way that it would coordinate would be that the subject to tax rule could apply collecting the tax at the source country level. And then perhaps if there was more tax that was yet to be allocated, the IIR or the UTPR could provide that top-up tax to the income inclusion rule. The subject to tax rule does apply to payments between entities that are under a common control. And there'll be a defined category of payments that this rule is limited to. So they're typically the types of payments that are subject to withholding type taxes, interest and royalties. But the inclusive framework statement also said that it would apply to a defined set of other payments. It didn't expand on what those might be, but if we go back to the October blueprints, it included things like franchise fees, insurance premiums, guarantee fees and rents and marketing hub payments and that kind of thing. So there's clearly a lot of further technical work that needs to be done on that space. One addition that the inclusive framework statement did make was that the subject to tax rule would be implemented by a treaty change, and it would be implemented by countries who have a nominal corporate income tax rate below the subject to tax rate minimum, so below that 7.5% to 9% minimum rate. The treaty-based change would only be done through those treaties if they're requested bilaterally by one of the partners. So it's possible that the scope, or at least the number of treaties that might be impacted by the subject to tax rule, could be narrower than we originally expected. If we flick forward a couple of slides, we'll just touch on some of the detail, I guess, or dive into some of the detail on the income inclusion rule. Okay, so one of the key aspects to the income inclusion rule is that it will apply on a jurisdictional basis or country by country basis. If we take this example here, country A has implemented the income inclusion rule and has a number of subsidiaries and a branch in a foreign country across country 1 and country 2. Now, each entity or branch, let's assume that it has derived $100 of profit, but is subject to a different rate of tax. And this might be because the type of income is concessionally taxed, or that there is perhaps a tax holiday applied at the entity level. Now, the first thing to note is that the branch profits that are actually sitting in ACO in this example are sitting in country A. Now, the switchover rule, which is actually part of the income inclusion rule, operates here to ensure that effectively the branch is treated on a par with the companies or the entities within that country. So the switchover rule first operates to ensure that branch E is effectively treated in the same way that DCO is treated in this example. Then you can see that the effective tax rate across the entities within each country are blended together. So that in country 1, even though BCO has an effective tax rate below the minimum of 15%, because company C has an effective tax rate of 40%, the blended rate of the two combined is 25%, so it's above the minimum. So therefore, there's no top-up tax that would be allocated or determined in respect of country 1. However, on the flip side, in country 2, DCO and branch E are also combined in a similar manner. So even though DCO has an effective tax rate of 15%, because it's combined with the profits of branch E in this example, the effective tax rate for country 2 as a whole is below the minimum and a top-up tax would apply. I guess what this simple example really shows is there's a need for a level of coordination to be done by ACO at the parent level, and the information gathering requirements for ACO will obviously be quite significant. Interestingly, because the IIR doesn't apply to profits in country A, ACO will still be subject to the IIR even if it has a loss in country A for the year. And I think that is important to note when we compare to the UTPR. If we flick forward onto the next slide, please, we'll just try and walk through what happens if the global parent does not implement the income inclusion rule. So the inclusive framework statement says that the methodology is yet to be agreed for the UTPR, but the concept is that the UTPR would step in and allocate that same amount of top-up tax that was worked out in the first example to members of the global group that have implemented the rules through this backstop or mirror rule called the undertax payments rule. So the undertax payments rule is a formulaic approach, and in the blueprint there were 2 allocation keys that were suggested as ways to allocate the amount of that top-up tax. Now, if we look at this example, A does not have the income inclusion rule in its country, but B and C have implemented the rule. Sister company D, however, is not being subject to tax because in its jurisdiction, there is perhaps a 0 rate of tax on that type of income, or again, imposed on the entity. So in this example, we have $1,000 of profit in DECO, including $950 from external third parties. So the first step is to look at the profits by jurisdiction, and we apply the 15% minimum rate to that amount of profits and identify that there's a potential of $150 of top-up tax to be allocated. So what the UTPR does is it firstly looks to whether or not there have been any intragroup payments by group companies to the lowly taxed company D. Here there is a $50 payment from company C. So C can collect the top-up tax using the first allocation key. But country B can also collect some of that top-up tax using the second allocation key because it has made intragroup expenditure or intragroup payments as well, albeit not to country D in this situation. Now, there is a cap that is applied based on the domestic rate, so the rule can't go beyond effectively cancelling the tax impact of the deduction. So in this example, the allocation to B and C is limited to $25 and $12.50 respectively because of that cap that's in operation. Okay, if we move on to the next slide, please. How do we work out whether there is an amount of top-up tax to apply? So as we said, the effective tax rate is worked out on a jurisdictional basis. So the first step is to work out the profits that the group has in each country where they have entities. This will be based on the tax residence, and there are rules to allocate profits where entities are residents of nowhere or they're hybrid entities and the like. This is compared to the taxes paid, and the kinds of taxes that are taken into account are taxes on income and profit. So that includes withholding taxes as well as foreign and domestic income taxes, but it excludes things like sales taxes and indirect tax, as well as DSTs, which will hopefully be gone by the time we have these rules, because they're all excluded on the basis that they aren't taxes on income. Then there are also some rules around allocating those covered taxes to particular countries, so to the jurisdictions where the profits are derived. For example, taxation that's imposed under a CFC regime would be allocated to the country where the profits are actually earned, rather than the country where that CFC tax is imposed, being the residence country. If we flick forward a slide, thank you. That first part was the taxes part of the equation. This is a description of what's in the tax base. The starting point for the tax base is the group's financial accounts. This is consistent, of course, with Pillar 1, and it's believed to be the simplest approach to having a uniform system that will apply consistently across different countries. There are some adjustments and special rules, for example, to make sure that PE profits are based on local source country tax rules. Once that financial accounts data is gathered for all entities within a country, there'll be a limited number of book-to-tax adjustments to reflect some common and material items like dividends, gains on disposal of shares, and share-based compensation. So, for example, dividends from a subsidiary would be excluded from the shareholders' tax base to avoid double counting those same profits at the subsidiary level. And this would be subject to exceptions for things like portfolio dividends, for example. There will also be expected to be rules to cater for asset reorganisations and accelerated depreciation and the like, so things that are a limited number of book-to-tax adjustments. And I think there's really quite a lot more technical work required on the mechanics of how that's done, because again, the need is to balance it with a simple system, or as simple as possible for countries to implement. Just going forward one more, we'll just talk a little bit through the some of the carve-outs and carry-forward rules that exist. And these are really designed to try and smooth out volatility on the effective tax rate arising from temporary differences. So first up, there'll be a rule that will allow losses to be carried forward and used to reduce the tax base in future tax periods. And secondly, there'll be a rule that deals with excess taxes. For example, if tax is imposed at above the minimum rate and it's paid in a particular year, this can be carried forward and applied in that same country as a local tax carried forward in a future income year. If we contrast that, if an income inclusion rule has applied and the top-up tax has been paid by the parent entity in a prior year, that excess may actually be converted or create what's called an income inclusion tax credit, and that credit might be able to be used by the parent company across multiple jurisdictions. It's been suggested that the excess tax rules be limited to a 7-year period. So there are some practical challenges there for businesses with longer business life cycles, and there's a lot more technical work expected to be done on that front. And perhaps just one more slide, we'll just lastly cover up on the formulaic substance-based carve-out from the tax base. Just one slide forward. That will adjust for capital and labour-intensive profit. So this will be welcomed by businesses that are driven by workforce and tangible assets, with the carve-out essentially being based on a 7.5% markup on payroll costs and the carrying value of tangible assets. The inclusive framework statement has noted that this rate be a minimum, so that it's at least 7.5% in the transitional period, and it could be reduced to at least 5% after the 5-year transitional period. The important thing to note with these carve-outs, because there was a lot of discussion around the blueprints by industry seeking some carve-outs from these rules, it's been confirmed that regimes that are compliant with BEPS Section 5, so that's harmful tax practices, will not be carved out. And so the limit is really on these two substance-based formulas at this moment. With that, Bob, I think I'm handing over to you to maybe compare this with what's happening on the US GILTI rule.
Yeah, sure. I mean, if you think back to the point Amelia made about if you don't have a good min tax at the top, a good income inclusion rule, then imagine if US GILTI rules were not treated as a good income inclusion rule, then all US parented multinationals would have to look for the pockets of undertaxed income underneath the US parent and apply that undertaxed payment rule using book tax methods that Amelia described. Now, the US GILTI, for those of you who may or may not be familiar, excuse me, our GILTI rules really don't look a lot like the rules being proposed at the inclusive framework. You know, for example, it's not just a top-up tax. The income actually flows up onto the U.S. return. You get certain haircuts for foreign tax credits. You apply expenses. So the U.S. had an interest in making sure that the rest of the world would be willing to treat our GILTI rules as a good income inclusion rule, so U.S. parented multinationals get out of the undertaxed payment rule, you know, down the chain of its companies. But up until now, the U.S. GILTI rules, first of all, our rate is 10.5 to 13.125, depending upon your facts. And the U.S. GILTI is done not on a country-by-country basis, but on an aggregate basis. And so if you look at this, this picture on the left, we have a U.S. code that has the GILTI rule, and now you have an income inclusion rule country in the middle. Another feature of the income inclusion rule is it should only be collected at the top co. And so the question here would be, would that income inclusion rule country turn off its income inclusion rule and regard the U.S. co as having a good income inclusion rule so that the intermediate country would not have this income inclusion rule? So that question kind of shows up there. On the right side, you could also have an income inclusion rule country. Let's say it's an Australian company that owns a U.S. company. Would the U.S. turn off GILTI? Because remember, you're not supposed to have an intermediate income inclusion rule. And in the Biden administration's proposed statutes, they are talking about giving some kind of credit towards GILTI to the extent that income was already taken into account under an income inclusion rule above the U.S. That would be a statutory change. You know, the last point to make here is I mentioned two things. The U.S. currently does not have a 15% min tax rate, and yet they have sold the world on having a min tax of at least 15%. And the U.S. does not do its min tax on a country-by-country basis. It lets you aggregate the income of all your subsidiaries below the parent together and all the calculations. But the U.S., of course, has just agreed that we would move to a country-by-country system, which is what the Biden administration has proposed. So the big question on everybody's mind is, what happens if the Biden administration doesn't succeed in either increasing our GILTI rate to at least 15 or getting our GILTI to be done on a country-by-country basis? Would the rest of the world then subject U.S. parented multinationals to the undertax payment rule because the U.S. was not able to deliver on the very deal that it was trying to sell the rest of the world on because our Congress may or may not have gone along? We'll know the answer to that this year for sure as all our politics around our tax reform play out. But there's a lot of interaction there. And with that, I think we go over to David on next steps in implementation.
Yeah, thanks, Amelia, and thanks, Bob. And just maybe leaving on that slide for a moment, I think the a lot of that presentation brings back to this description that I had earlier. There's a political aspect to this and a technical aspect to this. And the political aspect is very simple. You know, if you think about Pillar 2, it's a global minimum tax at a rate of at least 15%. It's a 10-second grab. The politicians have said their piece. But as we know, in real world, in tax, once you get below that political statement and down into the detail, there is a lot of detail. There is a lot of complex detail. And that's really going to start to build up over the next over the next part of this process. So what we're trying to capture here is what happens next. So we're sitting on the left-hand side of that timeline around June or July. We've had the high-level political statements, G7 inclusive framework, G20, high-level, everything's agreed, and it's all very simple at a political level. The next key milestone is in October. There's a G20 finance ministers meeting, there's a G20 leaders meeting in October, and all the momentum is around the sort of next step in this process crystallising in October. And if you listen to some of what Pascal Saint-Amand has been saying recently, and again, he's sort of talking that political level, it's all very simple. All we need to do in October is just agree a couple of numbers. It's as simple as that. So what he's referring to there is some of the high-level features that need to be settled is, well, what is the global minimum tax under Pillar 2? Up until now, the narrative has been at least 15%. As Bob said in the background, the US is sitting at a 10.5% GILTI rate, but looking to increase that. What is the Pillar 2 rate? Is it 15%? Is it a higher rate? So we expect to see that number agreed at a political level in October. So that's, when Pascal says all we need to do is agree some numbers, that's one key number. The other key number, the second key number to be agreed in October, is going back to Pillar 1, Amount A. What is the slice of global profit above the 10% profit margin that will form Amount A? And the statement at the moment is it will be somewhere between 20% and 30%. So we expect that number will also be hard-coded, locked in October. So at a political level, they're the two missing pieces that we can expect clarity on in October this year. At the next level down, once you start to get down into the detail, into the technical, the other key element of what we can expect in October is more greater clarity around the implementation. I think it's an open question at this stage as to what more technical detail will emerge in October. Maybe there'll be some, maybe there won't be, maybe the blueprints will be updated, maybe aspects of them. It may, on the other hand, it may be that we don't get any additional technical detail in October, but rather what we get is an implementation plan running us from October 21 through until 2023. So let me just talk a little bit about what we know so far about what that timeline might look like. So I'll just kind of talk about the what we can expect, and then I'll ask Bob to comment on some of the pieces in the background that may affect the timing or the interaction of some of these steps. So what can we expect from October onwards. And again, the easiest way to do this is to break it down into pillars. So above the line, we'll talk about Pillar 1. Below that calendar line, we'll talk about Pillar 2. Pillar 1, there already is a great deal of detail. There's a 200-plus page blueprint. That said, Pillar 1 has changed shape. We've moved away from consumer-facing, et cetera. We've moved to the largest and most profitable companies. But even if you go back to the blueprint, there are a lot of challenging unanswered questions. So in the underlying detail of Pillar 1, there's significant ongoing technical work to be done and development of model rules that will be led out of Paris. There's also the need to develop a new multilateral instrument. We're already familiar with the concept of a multilateral instrument going back to Action 15 of BEPS 1, but this will be a new and a different multilateral instrument. And why do we need that? For the reason that I said earlier, that Pillar 1 is breaking away from a physical presence concept for a country to have taxing rights. If you look at any bilateral treaty around the world, broadly, it will say that foreign enterprise cannot be taxed in a market country in the absence of, on its business profits, in the absence of a permanent establishment. Pillar 1, Amount A, just drives right past that and says we've got this new nexus rule. So treaties will need to be amended, updated, expanded to permit Amount A to be levied by those various market countries. And again, that just can't practically happen on a bilateral basis. It has to happen on a multilateral basis. So there's a need for a multilateral instrument. And then you get down to the country level. This is countries all around the world will then need to pick up the ongoing technical work and the model rules developed in Paris, pick up that multilateral instrument, and then figure out what is my country going to do? When will I sign? Will I sign the multilateral instrument? What's the process for a country to do that? How do I go about implementing domestic legislation? And if you think about domestic legislation, there'll be countries around the world where these largest and most profitable companies are headquartered. So there'll be countries around the world that will actually be imposing and collecting the tax on the relevant entity within those largest, most profitable multinational groups. But then other countries around the world, the market countries, they also need to implement domestic legislation so that they can impose and receive their share of Amount A. So there's domestic legislation needed both for collection and for imposition of that liability. And of course, that all needs to go through the normal parliamentary government political processes in each country. Amount B, technical work, as I've mentioned, that will be ongoing in the background in Paris over the course of 2022 with, and if you say it quickly, it might sound, well, the OECD even does describe this as ambitious, but with a goal of Pillar 1 being in effect in 2023. So what that says is there's an extraordinary amount of technical work, of passage of law, of signing multilateral instruments to occur from October of this year through until the end of calendar 22. And then dropping down to Pillar 2, it's broadly that same kind of framework. There's technical issues to be resolved centrally in Paris. There's model rules to be developed centrally by the OECD. There's a need for one or perhaps more than one multilateral instruments to be developed and for countries to sign up to. And then again, countries will need to impose pass domestic law to give effect to an income inclusion rule or an under-tax payments rule. So again, under Pillar 2, a significant amount of work to be done centrally and then in various countries, but again, with a view to Pillar 2 being effective in 2023, albeit with the possible deferral of the under-tax payments rule for that to be lagged perhaps by 12 months. So that is an extraordinary amount of work, and even if your company is going to be affected by Pillar 1, Amount A, or by Pillar 2, or perhaps by both of those, focusing on what's happening globally and what's happening in your relevant effective countries is almost kind of like a full-time job for a lot of people in large multinational groups around the world. So, Bob, that's kind of a description of the OECD high-level timeline. We expect some more detail on that in October. what are some of your observations on how that'll be achieved, what the challenges might be, what will go on behind the scenes? And Bob, I think we still need you to come off mute.
Sorry. I think the first thing,
Very good.
I opened up by talking about the politics in the U.S. that drove them to push Pillar 2. And I think the first thing to recall about these deadlines is that they're more political statements. Because from the U.S. perspective, remember, they have to convince Congress that the world is actually coming along and doing an increased min tax. And imagine if the U.S. said, oh, but the rest of the world will come along in 2028. Well, Congress is not going to be that interested in perhaps raising our guilty rate. From the OECD perspective, they need to also demonstrate this political momentum by keeping these deadlines tight and short and ambitious. Because I think their political calculus is the moment this project just becomes one that rolls on for years and years, and I would point out we had our interim reports in 2018, and we're sitting here in 2021, so it's already been moving along. But the moment the world sees this as a kind of a never-ending project, the political impetus gets lost. So that's big point number one. Big point number two, unlike in many countries, certainly in the U.S., when the Congress does legislation, they will often say, well, we got to some technical issue. Let's have the Treasury Department write some regulations to kind of work through those tough issues. But you don't really have that kind of an option in this global scenario, because both Pillar 1 and Pillar 2 really have to sync up in almost all the technical details. Otherwise, in Pillar 1, you can't administer this new taxing allocation right. And in Pillar 2, you run the risk that there would be you would run the risk that there would just be double taxation, because different countries will apply either the income inclusion rule or the under-tax payment rule or the determination of the effective tax rates differently. So that makes, I think, this mechanical task of getting this work done, really, really challenging. And I will say I do not think it is, all done as we sit here today. The third thing to observe, if you just take a moment on Pillar 2, in talking to my European colleagues, the Europeans believe that Pillar 2 has to be done through a directive in Europe. And when they do a directive, they need to draft it. They need to get unanimity in Europe. And typically, they will allow something like 18 months to 2 years for the countries to transpose a directive into their domestic law. And so right there, at least my European colleagues are wondering how it would just be physically possible, or just possible in the political system, to move something like, Pillar 2 along by those dates. So these dates are ambitious and extraordinarily challenging. I would just say that I think the fact that they reached political agreement this year, people thought was ambitious and challenging, and they seem to have pulled that off. So we have to stay tuned. My expectation is whatever we see in October, there's still a lot of technical work to do, and we'll all be, in a sense, watching as this plays out to see how fast it can really happen, and we can measure that back against these dates.
Very good, Bob. Thanks for that. And look, we're coming right up to the hour, so we will wrap up there. We've touched on some of the questions that have come through. A number of the questions are quite sort of specific to some of the examples. So any questions that we have not touched on in the session so far, we will respond by email to those specific questions. So look, we are living in interesting times. If international tax systems only change once every 100 years or so in a significant way, this is it. It's our time to be participating in that change. So extraordinary amount of change and challenge looming for all of us as tax practitioners trying to steward our businesses through these changes. So look, let me wrap that up. Bob and Amelia, thanks to you both for your time and contribution. To all those who've joined this session, thank you very much as well. We hope that it was of help to you to set a broad framework for how to think about what's happened so far and what's ahead of us. If you joined us late, please note that this presentation will be archived for future viewing, and please share with colleagues who who may be interested in that session. As I mentioned, we will respond to questions we've not answered as quickly as we can. We'll revert by email. If you have any other questions or comments about today's sessions, please feel free to contact Bob or Amelia or myself. In our ongoing Asia Pacific debrief series, there will be an upcoming session early August dealing with indirect taxes and export controls. So please continue to check into the Asia Pacific debrief schedule as this series continues on an ongoing basis. And finally, from us all here at Deloitte, thank you for your participation today in this Deloitte Asia Pacific Tax webcast. And we wish you well navigating all of the challenges ahead of us, including Pillar 1 and Pillar 2. Thank you very much.